So you had oil, and we've been watching oil for a while, yeah, there you go. Wow, right on the nose. So we were watching oil for a while, and right at 78, 77 this morning, I said, let's short it because it was running up. You know, there's more to just saying oil's expensive. And it's been very scary to short. It's been very volatile, and it's been very tempting to want to short it. But last week we tried one. We lost, you know, $100 or so because we were too early. And so I said, that's it. I said, I can't call it. I can't be sure. But today, a lot of the rise from last night seemed to be, first of all, the dollar was stronger. That usually pushes oil down. Instead of going down, oil went up. Oil went up because of the API report. And this is the key to you know, making a proper bet, is you have to have a good reason. I mean, an actual catalyst that you can see that makes sense. So this morning, I was looking at the, oh, I shut that down. Go away. Wow, this thing will not close. I'll come back next. No, thank you. Now will you go away? Annoyware is a growing business. And basically all these things, when you click these things to say I agree, you're basically agreeing to let them annoy you forevermore. I don't know, why are you being so slow? Well, this is not good. All right, while we're doing that, I don't like this. Oh, finally. So where was I? This morning. Oh yeah, we're gonna need this, and it's gonna have to be refreshed also. All right, so where did I start? Oh, this is not in order. It's kind of weird. Oh, I see. My response to the question was early. The question that I responded to was earlier. That's why I was wondering, because that wasn't the first thing I wrote. All right, so here, after really we haven't traded oil for like a month, and I said, look, API was a net draw, and that pushed oil up to. So here's what API looked like. It was an 8.5 million build in crude, and we know that when there's a build in crude, and this is way over expectations at 2.6. So we know that when there was a build in crude, that oil tends to react to the headline. When the EIA report comes out, it doesn't matter what gasoline and distillates are, the headline gets reaction. So API showed a massive build in crude. Gasoline was a draw that wiped out the build in crude. So they used the crude to make gasoline, or I'm sorry. Yeah, they use the extra crude to make gasoline. That's not, you know, net is what matters. And the distillates made it a total draw. So on the whole, it was a draw. But so what I saw with oil was negating the dollar's effect and going up despite the fact that the API report was absolutely, whoa, what's this? Oh, it's gonna stop. It's gonna stop out. So despite the fact that the API showed a headline draw, oil kept going up. Oh, there it goes, stopped. See? Okay, I should have taken the extra 15 cents, right? That's not bad though, $3,600. So we were at 78, 77, and I was willing to risk the 200 and whatever dollar loss at 79 because it seemed to me that when we got the EIA report at 10:30, we would go down. And we actually started going down before that, but fortunately, we hit it on the nose as far as this. And then after that, I noted that 77.50 was a stop out for half. And then 78 would be a stop out for the, oh, I meant 77. Oh no, I'm sorry, I didn't mean 77. I meant 77.50 was a stop out for half on the way back up if we bounced, but we never really bounced. Oh, where is this thing? There, that's what I meant. So at 11 o'clock, what time was that exactly? At 11:03, it was 11 o'clock. So at 11 o'clock, I said 77.50 was going to be a stop out for half. All right, so technically it should have stopped there, but you know, I'm writing, so I pay attention to my own stop out. But 77.50 is a stop out for half, and then if it goes higher, it would be 78. It never went higher than 78, and then it actually started falling. And then I just said, well, 77. It's like now it's time to just not be greedy, and let just take it off the table. That's plenty. That's a huge move for oil for one day. So we're very, very happy. And I mean, it's 77. It was 78. Yeah, it's like $1, $1,500, $1,600 per contract. So fantastic. That's all you ever want out of a commodity move like that. Now, natural gas, we had a whole conversation about because it's tempting for natural gas, which is at, if I can find the futures. Oh, where'd that come from? Oh, a long time since I used that. We were talking about the natural gas futures, but where's my futures charts? Oh, so weird. Well, that's FinViz, but it's the wrong FinViz. So let's do this. Yeah. So natural gas has been down and down and down, and this is all because Biden is reviewing the export licenses for new natural gas terminals. We have been drilling and drilling and drilling natural gas, and we have tons of it. We're like Saudi Arabia for natural gas. We've been drilling and drilling natural gas to export as liquefied natural gas, and it was all boom until Biden is now reviewing these natural gas export terminals and may not be permitting them so quickly because they themselves are polluting, and they're basically not environmentally friendly. And so unless they can start building them better, they're not going to be so quick to grant permits for this stuff. Not to mention the actual production of natural gas is releasing greenhouse gases. So we're not. It's not a clean energy that we were hoping for with natural gas, not the way it's being done. And so that's freaking out the entire sector, and we've dropped almost 50%. We have dropped 50% since this review process began. They're not going to not permit exports of LNG. On the whole, it's better than the trade-off, but what the environmentalists are saying is the trade-off is we're polluting in America and exporting clean energy. Liquefied natural gas is undoubtedly clean energy, but we're making the dirty. We're creating pollution to make clean energy to send to other people. We're not benefiting from the clean energy. It's tricky because if you look at it from a global perspective, it's probably for the best that we're doing it, but it's not in my backyard kind of thinking. So that had nothing to do with the actual supply and demand is what's causing this drop. And it's really tempting to bet natural gas here. Look at this. Because break even on natural gas is about $2. And so it should not be able to sustain a long period below $2. But this is very artificial because it's being regulated down. And the thing is, all these wells for all this expected export have already been drilled, not just for the export that's going on now, but for the massive export that's supposed to be coming online this year. There are now these projects are being held up, but the wells were already in production. Once you start a well and once you start drilling it, you committed the funds, you committed the resources. The situation drastically changed with the stroke of the pen, and this is what happened. So still, even knowing this, because it's only been a month or two, even knowing this, the wells are still coming online. Wells that were started here, all the way back to probably last summer. So the wells that were started last summer with expectations of this happening are now seeing this happening instead, but you can't help it. They're still getting built. You can't pull the plug on them. You're going to take a total loss. But if you try to sell your natural gas into this market, you're taking a loss on the gas you're selling. But what are you going to do? You got investors waiting for a payback. Their payback is break even at 2. You're at 160. So you're thinking maybe on a 5-year cycle of the well, I'm gonna just take a loss the first year. But you know what the problem of the well is also? The first year is when most of your gas comes out. Half the gas is pushed out during the first year. Maybe 40% of gas gets pushed out in the first year. After that, it's a more difficult extraction process. So in other words, when you first drill the hole, there's a lot of pressure and the gas comes flying out. But after the first massive amount is taken out, now you start having to refill the well with other things to push the remaining gas out and filter it and so on and so forth. It's a lot harder as it goes on. That's when the production costs ramp up. So first year volume wise is when you're going to sell the most, but if you sell the most at a 40-cent loss, and then it's never going to be a good operation. It's going to be a disaster. Where were we? Okay. So what is the status? That's the thing. That's a good question to ask Bing. Let's see if he knows. Let's ask Shellbot. Sorry, this conversation has reached its limit. Fine by me. What has been the effect of planned U.S. LNG exports due to Biden's review of new terminals, and how is it likely to resolve? Over what time period? Now, I was talking about productivity today, and you say, how can you possibly not be more productive when you can get answers to things like that? I mean, I can make it. That's a question that even a really competent researcher would take at least an hour or so to get back to me on. And meanwhile, I can have that answer immediately. And that allows me, the boss, to move on to my next chain of thought. So of course it's productive. It's not just about the fact that it's getting done faster. It's the fact that I can remain on task. You know, me, the guy driving the company or driving the deal decisions or whatever, I'm able to remain on task. It doesn't even really have enough time to interrupt my thought process before I have a response. Now, of course, someone's got to check if the response is right. So some combination of this and somebody who could check it for me would be great. So the effective plan to LNG due to new term has been delayed. Approval process for new projects, while existing projects under construction are not affected. The administration, so existing projects under construction are not affected. That means it's really not going to have that big of an effect. There's a lot of projects that are in demand, and the ones that weren't in process are quite a long time away from being developed. So it really isn't affecting the net export of natural gas that much. The administration announced it will develop a new approach to evaluate the potential climate impacts of LNG as well as the costs and benefits for American consumers and manufacturers. This review is expected to take several months. No new approvals will be granted in that time. The future of U.S. LNG exports depends on various factors. According to the energy, exports are projected to increase from 27 billion feet per day to 48 billion feet per day in 2050. That's huge. It's going to almost double between now and 2050. And there'll be higher international prices and so on and so forth. This scenario is uncertain and could change if the market conditions are regulatory. So now it's all subject to regulatory approval. And then there's articles we can refer to and check out. I'd like to see a chart or something. That's what I'd like to see a chart of who's under construction and what's going on. How long, blah, blah, blah. Anyway, so given all that though, what happened is we were talking. So I was saying, I in my gut, see, this is me, I have a gut feeling. I felt like this, and that's why we haven't been playing the natural gas for the bounce, even though it's like so tempting, because long term, this is just really unsustainable. I mean, look how low we are. This is back from 2000. You know, you can't go below 2 because it costs $2 to produce it. So sooner or later, people are going to shut down money-losing wells. And even so, what's going to happen is people aren't going to build new wells while the gas is so cheap, and then you're going to run out of wells because the wells deplete. And then you'll have a shortage of natural gas production. And especially if then they start back up with the exports, you're going to have a real shortage, and the world's going to feel this lack of natural gas, and it's going to drive up prices regardless. So there's many good reasons to do it. It's just in the very short term that we're in now, we don't know where this is going to stop falling, but it's ridiculous. And so in chat, and we've been talking about this for a while. I've been wait, but now it's getting, really seriously crazy low. And so this morning I started thinking maybe we should let's take a look at some companies that would benefit from a rebound in natural gas prices. And so I was thinking of NWN, and they've got, they're small, they're about $1 billion company. And they're a natural gas energy company in the Northeast. And in fact, Northwest in Northwestern natural gas. So my thought on this is that one of the reasons that they're down is because they haven't yet gotten permission to raise their rates from inflation. And so that's a factor also that's hurting them. That's been squeezing their margins, but their sales keep going up, and they are expanding at about 10% a year, and even their profits going up 10% a year. They just should probably be going up more. And they're getting killed by the drop in natural gas, especially, as you can see, it was 40 and now it's 35. That's from natural gas dropping off so much. But we already saw here, they formed a nice bottom here at 36 last time. Went back up to 40 pretty quickly, and now Biden screwed them up. But I think you're getting a real bargain here. Income was 86 million in 2022. Now it's like 90-something million in 2023. And this year in 2024, they expect to make like 106 million. So it's basically going up 10 million a year. They pay a 5% dividend, which is $1.94 per share. And I don't know, I wouldn't call it diversified, but you see Shellbot saying they have a diversified portfolio with natural gas utilities, water utilities, and net renewable natural gas projects. See, and when you're reading I like the good, bad, ugly, because first of all, you're reading what's good about the company, right? Get that out of the way, check it out. And then the bad. And when you're reading these item by item, you have to think to yourself, do I really think that's bad? So you say their stock declined by 20%. Okay, I see that, but That's not bad if you think that's part of the overall conditions of the natural gas sector. P of 14.1 is higher than the industry average of 11.9. That's why they've been falling faster. They were valued higher because their growth was higher, and now people are cutting them back. The natural gas consumption in the industrial sector, they had weak demand from pandemic-influenced industries, and we know that's going away. And regulatory uncertainties is definitely the problem that they're having. The natural gas utility business is dependent on the weather, yes, of course, but there's still a base of other things. As you know, natural gas is not just based on how warm it is or how cold it is. So you have to, take that with a grain of salt. Utility business exposed to risk of rising prices? Not really. They actually get to charge more when natural gas goes up. They're moving into these other businesses that are new and unproven. That's fine, but it's a pretty, they're a utility company. They're not like swinging for the fences there. And they have competition from other energy sources. Not so much. As we know from all, it's a utility. It's your home. So your home is built a certain way. People aren't that quick to change their home away from natural gas and whatever. Yeah, people are going solar and things like that, but it's a long-term process. It's not something that we should be worried about in the next 1, 2, 3 years. So as a play on natural gas recovering, I like them. And Shellbutt says they could be $39 a share, which is actually above where they are now. Oh, he thinks the current price is 39. That's why it's not. It's 35. So he's saying that his value is about. Oh, he's saying the fair value is about 30 based on discounted cash flow. But again, I think he's not taking into account the potential positives of getting out of this. He says afterwards, I'll show you, he says he is taking it into account though. But you can't trust him. He's like a little kid where you ask him like, did you take out the trash? And he's like, yeah, I took out the trash, and the trash is sitting right there. He's like that, so you can't trust the fact. If you say, did you take this into account? He's always says, of course I took it into account. It's very funny. But anyway, so I think it's a good bottom, and I think and the thing is, we don't need it to go up. We're just happy if it stays where it is, and we can make a play out of it. That's the advantage we have doing the options trades around these things. So that's great. Then the other one is Kinder Morgan. Now, Kinder Morgan, a much bigger company, $36 billion company. It's more like a blue chip stock, and they're not very likely to go much below $16, and even 15 would be kind of surprising if they get back to 15. So again, it's not going down. If I can find a stock that's not going to go down, that pays a dividend, that's a no-brainer. As long as it's not going to go down, it's fine. We don't care if it goes up. We care that it doesn't go down. And even that's, if it's only going to go down a little, that doesn't matter either for us. And I'll show you why. All right, I'll show you why right now. Let's take a break and look at a trade. So we look at Kinder Morgan. So they're at 1652. So I look over here and I say, okay, 1652. I can sell the $17 puts for $235, let's say. Okay, so let's call it $235. Wow, I can sell the $20 puts though for I'd say $460, $450, $460. I'd say $460. So if I can sell the $20 puts for $460, that nets me in for $15.40, which is $1 lower than the price is now. So I'm all for that. That seems perfectly fine to me, especially because it's going to raise this cash. So in other words, when you're selling a put, what are you doing? I'm promising to buy the stock, right? So if I promise to buy 1,000 shares for $15, I'm going to get $1,400. If I promise to buy 1,000 shares for $1,700, I'm going to get $2,300. But if I promise to buy 1,000 shares for $20, I'm going to get, what do we say, $4,600. So I'm promising to buy these shares. Now my margin is not going to be significantly higher. Even if I don't have, even if I don't have portfolio margin, even if I'm doing it against an IRA account or something like that, I'm still only committing here in margin $15,400. Here, I'm committing 15 minus 140 is $13,600. So it's $15,400 versus $13,600. So it's an $1,800 additional commitment in margin, but I'm getting $4,600 instead of $14. I'm getting $3,200 more dollars paid to me. Right? So why would I not take the more money? It doesn't make any sense not to. It's not enough of a discount. And again, I have to have faith in my process. So if I get it signed, I know that either way, I'm just going to be able to sell more puts and calls that are going to lower their basis anyway. So I'm giving myself a teeny bit of room to grow to get to 20 from 1650 over the next 2 years. If it doesn't, also another faith in the process, I'm going to be able to roll it. Because let's say I had the current $20 calls. So the February 20s are $350. All right. So if I rolled those 2 years further out, $350 for $1, I could roll to the 17s. So I could roll $3 lower for $1. Now, if I look at that, if I collected 420, like I'm going to do now, or 440, if I collect 440 and I give back $1 to roll down to 17, then I've collected still 340, and my net is better than if I had sold the 17s now. You follow? I hope you follow. So you have to think of like, I have this money I collected. I'm going to use some of it to roll lower. I still have the rest of the money against a lower position. So as long as it's really a matter of, as long as I really want to own Kinder Morgan for the long term in my portfolio, I'm just delaying the time I get assigned to it. Maybe I'll delay it forever and then I'll just keep the cash. But either way, I'm going to get it cheaper and cheaper and cheaper as time goes on. And again, it's fine with a blue chip because Kinder Morgan is almost certainly not going to go down to 12. So over the course of the next 4 or 5 years, I should be able to roll it until I get to 12. You know, it's hard to imagine a scenario where their whole business just completely collapses after 150 years. So that's why I like to do this with blue chips. It's just the fact that they're not going to go bankrupt means we have infinite amount of time to save ourselves. So I'm saying I would take the money up front. So let's say we sell 10. It's got to be a number you're comfortable double. Any number you ever enter into, if you aren't willing to double down when it drops 50%, you shouldn't be in it in the first place. So in other words, if I'm committing to 1,000 shares of Kinder Morgan at 20, all right, that's going to be $20,000. If it drops from $16 to $8, even though we think that's terribly unlikely, I have to be willing to buy another 1,000 shares for $8. Because if I do that, or frankly double down, I should really buy 2,000 shares for $8. But even if you buy 1,000, then I've got 2,000 shares for $28, and that's net $14 a share when the stock price is at 8. So it's not terribly out of reach. And then if the stock price was if my net was 14 on 2,000 shares, and I sold let's say that the 17, let's say I sold the $15 calls for $1.20. Well, let's say I sell the what's 2 below. So these would be like the 15s and these would be like the 13s. So let's say I sold the $13 calls for $2.30. All right. So now, what do we say our net was? Our net was 14 minus 230 is 1170. So now I've got the stock at 8 and my net is 1170. And then I could sell some more puts for another $1.40. And I'd be at net 1030, promising to buy another round of shares at I'm sorry, what did I say? I would sell the whatever puts, the 13 puts or the 14 or whatever puts, maybe the $10 puts, doesn't matter. And I would agree to buy more shares for 1030 to further lower my basis. That's without rolling if I get a sign, so on and so forth. As long as all that doesn't bother me, and it certainly doesn't bother me to own. And again, this is I talk about this a lot. You've got to have in your head, because to me, I'm saying, why would I not want to buy a huge amount of Kinder Morgan for 1030? That's my reaction to this thing. But it's not just a random number. That's the thing. You've got to be confident in the price of your stock the way you're confident when you go to the store and you see Levi's on sale. I always say Levi's because it's pretty simple, right? You see Levi's on sale. You know what Levi's cost. They cost 50 bucks, right? Basically, I think they still cost 50 bucks. I would say 50 bucks, but no idea now what inflation has done to them. But let's see. How much are Levi's? I guess not everybody buys the same kind of Levi's. How much are Levi's? Let's say 501s. Oh, really? There's all kinds of different prices. That's weird. 79. Who the hell's going to pay 79? Anyway, so let's say they're 50 though. They're still fit in my head. They're still 50. I don't understand how it can be this much of a difference. I guess dark stone wash. I guess they got the fancy kinds. 501. 30 bucks seems cheap. 20 bucks definitely seems cheap. Curbside. Of course. Oh no, that's Walmart. Oh, you gotta be 36.30. Oh, they all have a specific. I guess it's random then. Amazon. Don't even get me started with Amazon with their random prices. I would say 50. Look how easy it is to get them for less than 50. All right, so basically 40 is the price. But anyway, so you know what the price is. You can figure it out. You understand what the thing's actually worth. And that means that when you see it on sale, when I see 1992, although this is signature by Levi, that's interesting. So who knows what the difference is between this and that, but that seems pretty cheap. Maybe there's a reason that maybe it's not quite the same or not as good or whatever. This says men's original Levi's 501s are 30 bucks. So you know what a good price is. Was 40. If you know what the price should be, then you know what a good price is. So I know for Kinder Morgan that it should be 15, 16 bucks. So if you tell me you're going to sell it to me for 10, I don't care if it's because there's a recession. I don't care if it's because unless things drastically change in the natural gas industry and their whole business model is in jeopardy and blah, blah, blah. I don't really care about those parameters. I care about the fact that Kinder Morgan's a huge corporation, $36 billion a year. $36 billion valuation, not $36 billion a year in business. But I know they're big and steady. I know that other than probably the actual COVID year, they probably didn't lose any money. KMI. They broke even. So, 1.5 billion, whatever happened in 2017, 1.6, 2.1, 119, 1.7, 2.5, 2.5. So in other words, they came out of COVID taking advantage and got bigger. So it's a good, solid company. They do have a lot of debt, 30 billion in debt. That's always a little scary. But they're making 2 billion a year, so But again, this is why we haven't bought them yet, and I like them, and I just sort of would like to start watching them because their PE is good, they're servicing their debt. You know, the worries are pretty much behind them, I think. That on the whole, I think that these guys should do okay. And then NW. And then Northwest is a much smaller company. They've got $1 billion in debt, 1.5 billion in debt. So basically, they're the same as Kinder. They got as much. They've got their entire market cap worth of debt. But also, see this nice steady growth. That's what I like about these guys. So 60, 76, 78, 86, 96, 104. You know, they're moving up nicely and they're building, and they're a small little company. So it's very easy for them. So as a play on natural gas going up, that's what I like about these guys, is that play. They're going to react pretty quickly to a move up in natural gas. But either way, same thing. So they both pay a dividend. Kinder Morgan actually pays a bigger dividend than these guys. And Kinder Morgan just raised their dividend, which makes me kind of like them. So what did I say? Oh, I'm sorry. So we could sell the $20 puts as a starting position, and we could buy, let's say, the $13 calls for $4, and sell the $17 calls, which is barely, it's at $16.50 now, for $150. So let's say 4 minus 150 is what, 250? So it's net 250. So we could buy twice as many of these as we sell of the puts, and it's a basically no cost play. It's almost a free trade. And so what are we doing? So in exchange for committing to buy the 20 shares, the 1,000 shares of Kinder Morgan, let's say that we sell, and this is why portfolio margin is crazy, right? So we sell 10 for 440, and our buying power effect is only $1,700. So they're going to hand us $4,400, and the net effect on our buying power is only $1,700 for doing that. You know, yes, don't forget, you are obligated to buy. You're obligated to buy $20,000 worth of the stock. Just because your buying power hold is only $1,700 doesn't mean you're not obligated to buy 20,000. But you don't have to put the margin aside or worry about it unless there's a drastic pullback. In which case, hopefully our hedges kick in. And so if you combine that with the 13-17 spread, so let's say we did 10 of those and 20 of these, the net cost would be about 0, and you'd have 20 times 4, which is an $8,000 upside potential at 17. Now don't forget, we have the puts. It has to be 20 for us to really make 8,000. If it doesn't, we would make 3,000 less at 17. Let's say if it's a 17, we'd give 3 back, but we'd still be up $5,000, and all we did is margin out $1,700. That's very powerful. And like I said, as long as you're completely willing to double down on Kinder Morgan, if it goes like at $10 or something like that, then your worst case scenario is only 2,000 shares for 15, which is the current price, or it's below, actually it's 10% below the current price. So that's what I mean. We don't need the stock to go up to make money. And of course, we will roll the short puts down if the stock goes lower, and we'll put off that purchase for a while. We're not going to just run in and buy it. But in a catastrophe, yeah, we would have to double down. If it really goes down, if the whole market crashes 40%, then we're going to have to make a decision on that. But hopefully it'll just be a decision that involves pushing our hedge money around. Oh dear. There's a problem with Northwest. They don't have long-term options. They only go out till September. That's not going to work for us. They pay a dividend, but basically we're better off, if you're interested in it, you're better off just selling the short puts, the 35 puts, because you're going to collect your dividend up front. Basically, it's more money than the dividend would be, And worst case scenario, you end up owning the stock at 33. But yeah, it's not as really as good of a play with the 4-out options. Now let's see though, if we buy it for 35 and we sell the 35 puts for 3, that puts us in for 32.50. And then if we, I'm sorry, and we sell 35 calls, that puts us down to 32.50. And then we sell the 35 puts, that brings us down to like 30, that puts us down to $30. Then we make $5 plus the dividends in September if it's flat. So all I have to do is be flat and we're gonna make $5. If it's not flat, what do? We bought the stock for a $5 discount. We gave ourselves a $5 discount in the stock, plus we'll collect the dividends. Still though, I feel more comfortable with the Kinder Morgan play. Because again, they're more of a blue chip. I have very little thought that they're gonna go down. And now in this one though, as far as for playing for natural gas, they should go back to 40 if natural gas does well. So we could take like the 35-40 spread, which is 321. Let's call it 321.90, which is 240, and that'll make 100% if natural gas prices go up by September. Still, not a throw with a time frame. It only makes 100%. We're very greedy because we make so many plays that make more than that, but it only makes 100% in 8 months. And I just feel safer with the Kinder Morgan. If you say, would you mind being assigned, which one of these would you rather have stuck in your portfolio? I'd much rather have Kinder Morgan stuck in my portfolio. I like these guys, good little stock. I think it's a good trade, but if I was going to commit to the portfolio, I'd do it with Kinder Morgan. You know, and that's where the decision tree comes out. You know, you look at the stocks, you compare them, you pick it point by point by point and organize it. And I like the way this forces you to sort of organize your thoughts. This is what's good about them, this is what's bad about them, this is what's really bad about them. Here's the valuation using discount cash flows and so on and so forth. So I asked Shellbot, given this, I said to him, I said, I think natural gas, I said to him, I think natural gas is going to get returned to $2 because that's basically the extraction cost of natural gas. And have you considered that in your analysis? And he said to me, I have considered the current natural gas prices and the impact of Biden's review of export terminals in my valuations, but I don't agree that gas prices will necessarily normalize above 2 in the near future. Here's why. But this is what I want out of him. He tells me, Phil, I think you're wrong, and here's why. And he's saying that the price is 192, not 2. Okay, I'll take that. I'll take his word for that. But you don't take his word. I mean, you can actually look and find the link and take a look at what he's using for support. And if you don't agree with the support, then you can run more analysis to get to the bottom of it. But that's, you know, the bottom line is $2 is a good rule of thumb. Now he makes a good point. Some producers can break even with negative prices, especially if they produce oil and natural gas along with the natural gas. That's true. For some people, the natural gas is a byproduct of the oil drilling, so they don't care what the price of natural gas is. It's going to come out with the oil anyway. That's something I didn't really think about. It's a very, very good point. There are plenty of oil wells that natural gas is a byproduct. Just the way gold miners produce a lot of copper. They don't give a shit about copper. They produce a lot of copper because it's often found where gold deposits are. You'll find copper deposits. So when they're extracting the gold, they're getting copper, and they don't throw it away. They say, okay, we'll sell the copper too. So they sell it, but they don't care what the price of copper is. They care about the price of gold. That's their business. So that's very true, that you're going to get a certain amount of natural gas production regardless of the drop in price. How much, what percentage, and so on and so forth, and what's the total market effect, that's tricky, but you see where that's going. The natural gas market is currently oversupplied with inventories above the 5-year average. Yes, we know that. So the natural gas inventory is above the 5-year average. And what if he's using the EIA here? Nope, FX Empire. Interesting. Okay. Oh, it's that same article though. I don't like that. That's not technical analysis. I would look at the EIA report. Oh, here it is, EIA report. Ooh, look at that. He cited the same article yet again. It's interesting. I wonder if he's right. Natural gas exports have increased significantly since Russia's invasion of Ukraine. Now, there's another thing. He's not even saying that. What if the Ukraine thing stops and Russia starts exporting natural gas to Europe again? Then what happens? See, you know, a lot of the stuff's been going on with natural gas because Russia's had it offline for 2 years now. And natural gas prices are expected to average $2 per foot for 2024, according to the EIA. Does this one actually cite something besides that other same article? No, every single citation is the same article. That's bad. Based on, so I would have to go and double check all of his work, basically, but it doesn't sound wrong to me. That's the thing. It just, I don't know why he keeps citing the same article over and over again. So based on these reasons, I think they're likely to remain low. I don't disagree with what he's saying, though. That's the thing. It's just he's making good points, but I question his research. So now I would have to go back and go check to see if he's even making sense. But none of those facts contradict what I already know. But this is why bots is so dangerous. And we had that discussion too. So I'm going to quit this discussion. I'm going to quit this topic, and let's move on to the next topic. Lyft last night. Charts. See if we can magnify some. So yeah, so Lyft last night. What are we looking at? A 1 hour view. Yeah, okay, good enough. So Lyft last night had earnings, and there was a typo in the earnings that added a 0 to next quarter's projected revenues. And the stock went from 12 to 20. And it was a typo. And so then it crashed back down real quick. In the same hour, it crashed back down because they caught it. But this is the danger of listening to these bots. You know, it's like you can't just take the word of any of these bots. But the problem is everybody's using them. And so the source that you're looking at is using a bot, and the source that he looked at is using a bot, and the source that he looked at is using a bot, and it only takes one little mistake somewhere along the line, and this happens. And this is massive volume. 36 million shares got traded on misinformation. 36 million times 15, so $15. Well, it's not really 15, let's call it 17 average. 17 times 36. Is that really 36 million? That seems like such a large amount. Yeah, 36 million. So $600 million of trades were made under a false premise. And once you find out that this is wrong, there is no possible way to get that back. It's like, sorry, buddy, you thought you were jumping on some great information that these guys were going to go up, that their earnings were going to grow up 10 times in one quarter, and you believed it. You know, and that's the problem, because the bot has no reason not to believe it. They see a data point and they take it for granted, and they push it through. They don't have the part of the brain that says this doesn't make any sense. All right, they're like kids. If you tell, when a kid sees an elephant disappear off the stage in a magic show, they don't say that didn't actually happen, so there's a trick. They're like, the elephant disappeared off the stage. I saw it, therefore it happened. That's basically how a bot brain operates. It's like a kid. They don't have enough real world experience, nor do they have the effectively subroutines that would go back and give them those. They don't have the childhood memories. They don't have the experiential references, and so they don't have common sense. And that's why Shellbot will tell you things that are completely ridiculous, and then he will defend them and back them up, even though they're totally wrong. Because he's sure he's right, and he does. He's like he acts like a 5-year-old when it gets caught lying. ChatGPT is different, even though it's based on the same engine somewhere. But Shellbot, for whatever reason, he acts like a child caught in a lie. Like he will just start making more stuff up on top of the stuff he already made up to try to justify what he said, instead of saying I was wrong. ChatGPT, the main engine, will say I was wrong. Claude says I was wrong. But the Bing chat, which is still ChatGPT as an engine, just keeps going. Now, Google's thing, Bard, or whatever they call it now, but Google's thing just simply sucks and gives you completely incorrect information all the time. There's no point in talking to it because it's ridiculous. I can't believe how bad Google's engine is, and it makes me start questioning Google's facts. See, to me, if I ask Google how much are 501s, well, first of all, it can't give you a freaking answer. That's the thing. Now, if I ask Shellbot, there's another annoying thing it started doing is it flips back to it always flips back to Bing now. I'm trying to get you to use Bing. What is the price of Levi 501 jeans? I imagine it'll say prices vary. Okay, the average between 50 and 90. So now he's showing me things that conform to what he just told me. This thing, now notice how insidious this is, right? I looked on Amazon and I see lots of 501s for 40 or less. Why is that? So let's see what he says. Amazon may offer discounts. Amazon may have lower operating costs than physical stores. He doesn't understand how Amazon works. Amazon may source Levi products from different regions. Amazon may sell older discontinued styles, which are cheaper. Some of them may be counterfeit or low quality. That may be true. You could always check reviews, ratings, and customers. We should compare the product details, images without. All right. Anyway, so that's my impression of it. Anyway, so it conforms to my expectations for how much Levi's are. It's $50. But yeah, he's giving actual reasons why it may be different. But you notice how he wants to stick to his guns. He doesn't want to say that it's 40. I think you are wrong, and 501s are actually $40. Why are you wrong? I'm sorry, but I'm not wrong. So maybe he's sticking to his guns on that. So we could have a whole huge fight about that sort of thing. But anyway, they see Google gives me one thing and he gives me another thing. Really, it's 29, 30, 78, 50. It's all over the place. He's telling me $50 is the right price, which I agree, actually. So feel bad arguing with him when it's not true. But like I said, so this is what happens though. So it's the same thing if I say how much was Apple's earnings, or why did what went wrong here with this company, or even when you have a company and you're relying on the AI to tell you something, you say what's what's the orange crop going to be like in Florida? All right. So in other words, let's get off this whole thing. So let's forget we had that conversation. Well, this year's orange crop in Florida be better or worse than usual? And how will it affect prices and why? And again, look how much time I saved from having a research assistant and you know, and assuming you could trust it though. That when you can start trusting these things to be accurate, that's when the dam was going to break. But even so, just to be able to get this sort of information this fast. All right. The latest forecast for the USDA, this year's orange crop in Florida is expected to be 20.5 million boxes. Okay, problem, that doesn't sound right. To me, that sounds like not enough boxes. 30% more than last year's production. Holy crap. Holy crap. According to CNBC News, Florida orange crop is expected to be the lowest since World War II. This is due to a combination of extreme weather, blah, blah, blah. The USDA's forecast for oranges was, which is 62%. Whoa. Well, this year's, they're not talking about the same year, 2024. $20.5 million boxes, 30% more than last season. So he started off giving me a very authoritative, incorrect answer because it's based on 2022. But here he says the same thing without the date. Look how dangerous this stuff is, right? Florida is expected to have 43% fewer oranges than predicted at the beginning of the season, about 12 million fewer boxes and forecasts. See, that sounds like a disaster. And this doesn't sound good, but these were both wrong because they weren't talking about 2024. This year, 30% higher than last year. Now, this is actually actionable because this is a pretty drastic turnaround from last year. And like I said, research this. If I was going to actually make the bet, I'd have to do a lot more research than this. But meanwhile, I'm now curious. Look, oranges is still very, very expensive. It should not be because apparently we're going to have a lot more oranges produced this year. So you assume the demand for orange juice, the demand for orange juice is not going to be inelastic because if they're cheaper, more people will buy them. If orange juice is cheaper in the store, you'll buy it. I'm conscious of it because the only orange juice I like to drink is the Whole Foods fresh squeezed orange juice. I'm sure other people make fresh squeezed orange juice, like you can go other places, but consistency wise, they're generally pretty good. But it's freaking expensive. It's like $16 for a half gallon, like a milk size thing of orange juice. So I don't buy it very much. I just buy it for a treat once in a while. So I just, it used to be $10. Now it's $15. It pisses me off. But here it is, right? It used to be $10. Now it's $15. $10 I didn't mind paying. Thought that was a fair price for for a week's worth of orange juice. But it's like 15 just annoys me. It just seems like too much of an extravagance. So anyway, so the prices should come down pretty substantially because this year's crop is going to be a lot better. It's just and this is how you find things out, check things out, research it. But given that I find out what last year was, what this year is, what the crops say, I start reading some articles, it's bringing it right to my attention, and I can move forward quickly and get to an investing premise of some sort. So AI is great, but it can also be completely wrong. And then another AI which is looking for something may get the incorrect information from Google, and it may latch onto this and say, oh no, that's no good. I'm sorry, this is the correct one. It may latch onto this where it says Florida is expected to produce 43% fewer, and it's not going to know that it's the wrong year. And then it's going to come back to me with all incorrect information. And this is a problem that's going on in these trading houses. And this is your money. These guys are trading, JP Morgan, Citibank, whoever, they're trading with your money. And they're relying on these computers because it's easier and and theoretically more reliable than the traders they have now. but it can make a mistake and it would not even know it made a mistake. And that's where the real danger is. A trader has common sense. A computer does not. And when something seems wrong, a trader knows it's wrong, and a computer does not, and it'll go right ahead and execute a trade based on completely false information. And that's what happened to Lyft. Completely false information that makes no sense, still gets 36 million buys. So, you know, it's a tool, and it can be used correctly or incorrectly. And until people learn how to use these things correctly, we're going to have a lot of problems. All right. So that's that. How's oil turning out? Yep, there it goes. So 76, 77 was the floor so far. And then I wanted to move on and talk about hedging. I think we talked about that a little bit in the article today. Oh, so the thing about a drop like yesterday, and we're not really recovering that much, frankly. See, this is not very exciting. I thought we were going to have a much bigger bounce today, but we had a good start. It's a bounce. I mean, we were down at 17,550, let's say, and now we're at 17,8. That's a pretty big improvement. That's what do you say, 550 to 8? So that's 250 point recovery. And the drop was from 18.1. And now we're at 17.7, so you can see where you are. So the drop and that, so but still it's only a weak bounce, because if you look at it, and this is why this is so useful. 18, so let's call this 18.1. So we go from 18.1 minus, what's this number? 17.6. So to 17.6. So that's 500 points, obviously. So then we're at 100 point bounces. You divide the drop by 20 by 5, 20%, by 20% bounces. And so you take that and you're going to have 100 point bounces. So that's 17.6, 17.7, 17.8 is a strong bounce. When we rejected at the strong bounce line, that's not good. So if we stay below that, this is not a good sign. We may actually still have some downside follow through. And like I said, tomorrow's a big day today. And Friday we have the PPI. So there's a lot of chances that we could still go lower. But the key is, when you have a day like this, instead of panicking, we have our hedges and we don't have to worry about it. We're just like, well, let's see what happens. And we expect this. We expect to test this 50-day moving average at some point. Maybe it'll be next week. But we expect to test this over the next month, and that's what's going to happen. And we could go all the way down to this one. Hopefully, this 200-day moving average, or this week's. What is this thing? No, these are days. Sorry, these are days. So it's a 200-day moving average. So the 200-day moving average hopefully will come up to 4,600 before it gets tested, and 4,600 will hold and will consolidate and start having a sensible market. This is not a sensible market. This is 10% over a sensible market. So until we get lower, but that's why we have our hedges. But on the whole, the economy is pretty strong. Everything's going well. I don't expect any major correction. Warren was doing the facts and figures, and he sees a lot of positives, but here's the potential for the downside. It could go as low as 45. But probably here's 48. Hopefully if 48 doesn't hold, then we're going to slip around to 46 and be down around there and stay between 46 and 48, which I would think is great. I think that's good, healthy consolidation. See, this was good, healthy consolidation, and eventually we had a breakout. We had a little crisis there, which was unexpected. But even so, we had good, healthy consolidation for a long time, and then we had a nice breakout. But then it got too nice, and now we're overshooting. But if we can get back in this range, good, healthy consolidation, and then we can get up there. As earnings improve, as things look right, as the economy looks better. But on the whole, you know, we look at all this economic news. You see, when something is important like this, I trust it to Warren. I don't trust it to Shellbot to tell me what the actual numbers are and what's going on. But that's a nice summary he did, and well worded also, which is important. Very readable, and he put in a huge amount of data in a very short amount of time. And that's where we are with that. So then we'll talk about the hedges. Well, where are we? I just reviewed it yesterday, so let's look at the review portfolio. So yesterday we did our portfolio reviews. And the long and short-term portfolio combined are at $1.3 million, which is great. We started with 700,000, so we're officially doubled at 1.4 million. And we had 500,000 in long-term portfolio, 200,000 in the short-term portfolio. And why did we have 200,000? Well, first of all, we had $7 million in the combined portfolios that started with 600,000 in the previous cycle 4 years ago. So right before COVID, we started our portfolios. We were lucky because we caught the COVID dip and we bought the hell out of it as it was going down. And we had a great start to our portfolios in the last cycle. We last May, we restarted all new portfolios. And so in the new cycle though, instead of doing 500,000 and 100,000, 500 LTP, 100 short-term portfolio like we usually do, since we were cashing out $7 million, we said, okay, we're going to start with 5 and 2 because I was worried about what would happen in the market. So we've always had a little bit too much hedging in the short-term portfolio because we just weren't, we've always been concerned. So we've always had plenty of hedges. And combined now we're at 1.3 million, which is great. 1.4 million before May is going to be 100% up in a year. That's what more could you ask for, right? We had a huge gain since the last review, obviously, because the whole market had a huge gain. But the market was up 3%, we're up 9%. So we're well ahead of the market. And our last review was January 18th. So here, and we've had massive gains since November. Just every single time it's been up and up and up. So our money to our portfolio made that one we don't touch at all. That made $9,000 since last month. Those are totally static positions because we only trade on the show. And we do have a hedge on that one too. And here's the short-term portfolio. So here's what I want to talk about is our hedges. So the short-term portfolio review is up 63%, 327. Being, you know, the fact that the short-term portfolio is up in an up market is great, but that's because we do these offsetting moves. So we sell these puts. So if the market goes up, you know, what are we selling puts on? Disney, same thing as I talked about before. I don't mind owning them. So if you want to sell it to me, go ahead and sell it to me. So we said, I'll buy Disney for 85. I'll buy Generac for 100. We'll buy Barrett Gold for 15. We'll buy 3M for 95. It's actually 95 now. PHM we'll buy for 70. That's blasted past that. RTX for 80. Toll Brothers for 65. UCO is that's actually coming down now. The natural gas, well, that's a leftover from a bigger trade. And Walgreens, which I keep wanting to buy Walgreens, we never had, you know, we actually do own Walgreens, one of our portfolios, but Walgreens for $27.50, it's now at $22.60. We sold it for $5, so we're actually at our break-even point. It shows down 27%, but if we expire here at $22.50, we would have to give back $5. We collected $5, so it's break-even if we let it run its course. I'm fairly sure they're going to come back, so I don't feel any pressure on that. Then we even took a long play on Best Buy coming into the winter because we thought it would pop, and it has. We made some good money on that one. Cleveland Cliffs also, we thought we'd make money on it. We made some quick money. It's not a lot of money, but this is where we put it's a short-term portfolio, right? This is where we put our short-term plays. We felt that it was just timing wise to jump in to get it. It was worth doing. NYCB, we sold puts also, and that one we got burned on, but we got burned so badly on this one we sold these instead. Not instead, also. And now we're going to wait for the whole thing to bounce, hopefully. You know, but again, we're showing a $3,000 loss, but the stock is at $4.89, so let's say $5, right? So we're down $3. We sold them for $2.60. We're only down 40 cents. So we're down $800, not $3,000, but the rest is premium. You can't panic over premium. Not if, and again, it goes back to, do I really not mind owning NYCB for $8 minus 260, which is $540. $540 is the price that I said I didn't mind buying NYCB for. It's at $490 now. I'm very, very confident that it'll be over $540 and we're not going to lose money on this trade. We're showing a loss, but we're not going to. So those are our offsets for if the market is up, we expect those stocks to do well and put money in our pockets to pay for the hedges. Meanwhile, here are the hedges. We've got SQQ and we've got TZA and oh, look on Best Buy. I said they're good for, it's good for a new trade if you like making, our $30,000 spread is now in the money and it's only net 25.24, so it still can make $27,000 more dollars, 1,000% if $75 holds. They're protecting our gains, blah blah blah. It's good. It's good for a new trade if you like making 500% a year on your cash outlet. $2,524 cash, and you can still make $27,000 back. As not back profit, 30,000 total back. It's crazy that you can do this with options, but it's an amazing thing. It really is. That's what it. Do the math. That's what it works out to. Options are the most amazing. It's fantastic. But if you sell them, if you buy them, they're idiotic. But if you sell them, they're great. All right. So SQQ, did we change it? Yeah, we did change it. Okay. So we had $300,000 worth of protection. And what did we decide to do? I said the 25 puts are never going to go out of the money. So we sold the $25 puts. We don't think we're going to get back to 25. I don't see a catastrophe happening to the market so bad that we're going to get back to 25. Therefore, we're never going to get our money back. We need to do something about that, right? We can't just leave the $25 puts. They will never make us money. So in this case, we move and we shuffle them down to the $15 puts. So we move whatever it is, 60. How many puts do we have? Yeah, we have 60 of the short 2025 $25 puts, and they're hopeless, and they're 1540. So I said, let's roll them, and we're going to roll them to 100. We're going to roll 60 to 100 of the short 2026 15 puts. So we're dropping from $25 to $15. This is what I was talking about rolling puts before, right? We're going to roll the puts. We're going to make more of a commitment. But what's my commitment? My commitment is to own SQQQ at 15, and that's a permanent hedge that I'm going to have. And against that, I would then sell more calls and make more money. So I don't have a real problem with this. Eventually, though, if the market keeps going up relentlessly, this SQQ will drive down to about $5. And when it gets to $5, they're going to reverse split it back to 50, and that would hurt us. So that's something we need to keep a watch on because we don't want that to happen to us. So if we don't get a turn back soon, we're going to have to take some more drastic action to protect ourselves. And I said, here's a trick though. So we collected 51,000. We still have net 23,600. I said, but here's something fun. Instead of trying to make up the cash by selling more puts and having a huge commitment, so there's very little change in our commitment from having 60 at 25. In fact, I'll show you what it is. So 60 at 25 times 2,500 is 150,000 commitment, right? So that's our commitment to own SQQQ as it stands now on that set. Now, instead, we're saying we'll own 100. Well, this is going to be obvious. 100 at 15 is also 150,000. We're rolling the exact same commitment. So 60 at 25 is the same as 100 at 15. So we have no more commitment are we making, but we're pushing our strike down to 15. So that's perfect for us. But I said, instead of trying to raise more cash that way through more puts, because I don't want to have 150 commitment on short puts, I said, let's sell, let's get out of this. You want to make up the cash, I want to sell more puts. I don't have to sell puts in SQQQ. What's my premise of the short puts in SQQQ? The short puts are saying that the market will go lower, but I want an offset that's more bullish. So I'm going to sell the Boeing puts. And the 180 puts for Boeing, I can make $18,000. And the Expedia puts, I can sell for $14,000. So instead of selling more SQQQs, I'm going to sell these. And now I've got the same cash basis in my SQQQs to offset me. See, in Boeing actually, now this is a good sign too. Boeing had a flat day yesterday. It didn't even go down with all the mess. And Expedia actually is going up. Expedia is having an up week. So two things that I think are seriously bottom. Those were good choices. So that's the only adjustment we made to SQQQ. On TZA, I said I'm not worried about the short 32 calls. They're already up 67%, so we're going to buy them back. Not because we think it's going to go up, although it did. This was from yesterday, it didn't show to the action. Not that we knew it was going to pop at the time when I said this, but because it's run its course. If we wait another year, we're only going to make the 32% left, 33% left. So I said, meanwhile, we could just buy more of the long calls that we have for the same price. So that's what we're doing, is we're taking these longs, we're doubling down basically on that and doing a cover. So right now they were uncovered. So we have these uncovered longs. Now we're going to cover the longs. I'm going to have a nice big spread. So yeah, we have 200 here and 200. We're making that 500, 500, and these and we bought back these short calls. So that gave us the room. So we're buying these back, and then we're turning this into a 500 spread. It actually increases our coverage significantly. So now we have 450,000 worth of TZA protection and more than $300,000 worth of SQQ protection. So we're protected very, very well. You know, we've got 1.3 million total, and we've got $1 million worth of shorts. So that should keep us in very, very good shape. And that's what hedging is all about. You know, when you have good hedges, you know, and obviously if the stock market goes up, the long portfolio make much more money than that anyway. So we don't care about the losses in this portfolio. And that's what hedging is all about, though. It's like you want to be prepared for any conditions, and you don't have to panic when you have a pullback. You just sit there and watch, see what happens, and then make your adjustments nice and calm. All right, thanks everybody for coming. Oh, I wanted this question before I go. No questions. All right, fantastic. All right, thanks everybody for coming. I got to go, and I'll see you guys next week. All right, take care.